ask yourself before investing in apartment complexes? So, question number one is, when were the roof, furnace, AC, hot water heater were replaced? So, this is typically answered during due diligence, right? If you have the property under contract, um, usually you do something called a property inspection where an inspector will come in. If you're doing a property inspection for like a 26 unit, it took a full 8 hour day. I had, 3 to 4 inspectors there. I was there, my property manager was there, my general contractor was there. I had my whole team there. And usually at that point, the inspectors are going to inspect the roof. To make sure it's, how many years does it have left? They're going to inspect the furnace. Is it a recalled furnace? How many years does the furnace have? The AC unit, is it working? How many years left? The hot water heater, is it in code? Is it working? Is it end of life? And why you want to know this is it kind of gives you a gauge of how much capex you'll need and what to expect. Right? When you buy a C class apartment complex, like what I do, so C class is 20 years or older, so they're older apartment complexes. So with that, usually, you're gonna have to like see how the roof is and budget for that. Replace some water heaters, replace some air condensers. Like for my 26 unit, I had to replace the entire roof, and I knew that up front due to my property inspection. And I asked for seller repair credit, and it actually covered the cost of the roof for me of $30,000. So I have a brand new roof. I replaced a bunch of condensers, which I knew were end of life. I replaced some HVAC units that were end of life. I had some electric panels that had to be removed because they were recalled. Right, they're not safe and they're a safety hazard. So like I said, it's definitely nice if the seller tells you, but you always have to trust but verify. So the best bet is always to have a property inspection report. And then, insurance, they're always going to ask you, oh, when was the roof last replaced? When was electrical last replaced? When was the plumbing last replaced? And if you don't know, they're just going to assume the date or the year is when the building was built. So if my building was built in 1970 and I don't know of any updates, they're just going to assume that, the plumbing hasn't been replaced at all. So that's question number one. Question number two is, what is my competitive advantage as a real estate investor? So this is actually a great question because what you want to think about is, where do you have an unfair advantage in? And that's how you choose how to invest in real estate. And that's how I kind of guide my students and my mentees on how to invest, right? Like for me, I'm from California. I'm from the Bay Area. So I have an unfair advantage in the Bay Area. I'm currently living in Southern California. So now I have an unfair advantage in Southern California, right? I know the area. I know which pockets are good. I know which pockets are bad. I can drive there. I can physically see things, right? And, but as you all know, I have investment properties and apartments in Oklahoma and Alabama. So how am I doing that? I don't have an unfair advantage. But what gave me an unfair advantage was I have a really good property manager. Right? I have a really great property manager, or two of them in Oklahoma. And once I have those two great property managers who I know, they can refer me to everyone else, right? They'll tell me who's a general contractor that's good. They'll tell me which lender is good, what insurance agent is good, what pockets are good, what the rents are, how to renovate the units, what do I need to do to manage this? Like, what's the occupancy going to be? How do you evict tenants? Like, they're my boots on the ground, right? So once you have a vetted team that's your boots on the ground, and I get it, it's harder, especially when you're out of state, or you can't visit the property. Like, I barely visit my apartments. I only visit it when I bought it the first time, right? And other than that, unless I go back to Oklahoma to do another buy another property there, then at that point I might just visit all three of my properties, right? At that point, and make visits to all of them. But other than that, I don't really go there much. If I want to see the property, then I'll ask for videos, or they can like FaceTime me and I can see the video. But I'm really trusting that my property managers are doing their job. And you can always pay people to like drive by and film a video, like for my mobile home park in Alabama. I'll hire some people and I'll pay them like $50 and they'll just drive by, during the daytime, during the nighttime, record some videos to see how the park's doing. So a huge competitive advantage is, do you have property management there? Are you from that area? Do you have family there? Did you live there? I never lived in Oklahoma, Alabama, but I had a property manager there. So like, whatever that advantage is, that's how I choose how to invest in Oklahoma, right? And that's how I chose to invest in Alabama. I just had a great property manager there, and once you find a good property manager, which is hard, then you can scale around them. And that's why I tell them, like, hey, like, I want to scale around you. I want to buy more real estate, and I want you to manage my team. So that's question number two. What's your competitive advantage? And always analyze that, right? Like, I always have a competitive advantage in single family homes in California. I have a competitive advantage in Oklahoma because I have a team there now. So just work with what you got. Don't force anything, right? Question number three is, what's the property tax bill and will it change when I buy the rental property? So the property tax bill is actually public information. So what you want to do is you want to figure out which county the property is in. So for example, I own a house in Milpitas, California. I know it's Santa Clara County. So if you just literally type in Santa Clara County Tax Assessor's Office, and then it'll ask you to punch in the address. You punch in the address, and then once you have the address, you can see the property tax bill and what the annual property tax bill is. It's public information, right? And obviously, when you buy a rental property, the property tax bill will be recalculated, right? Because you're buying at a higher purchase price or maybe a lower purchase price, but they always base the property tax based on the purchase price. So if I'm buying it at like $1 million, and what you want to do is you want to find out the property tax rate for that county. So some counties might have a calculator on the website. So if you type in like Santa Clara County tax assessor's office, they might have a calculator for you to say, hey, I'm buying this for $1 million. It's 1%. So my property tax is going to be $10,000, right? So this is all public information as well. So like in Oklahoma, same thing, right? I looked up Oklahoma county tax assessor's office. I could look at how much property tax it was. It was like $6,000, and the value the property tax assessor gave it was $500,000. That's what I offered as well. So I kind of knew my property tax would be around $6,000. So it's a very easy question. I know people get psyched out by this, but literally just Google it. Like Google which county the address is in. Once you figure out the county, Google county name, tax assessor's office. At that point, you can search the address, and then sometimes they might have a calculator as well, and they'll tell you like what the property tax rate is. So I can be like Oklahoma County property tax rate, and maybe I'll find out that it's like 0.6%, and then you just do math at that point. So it's a lot easier than you think, right? For figuring out the property tax bill, and it just gives you an idea of what it is when we take over the property. So the next question is, what's the neighborhood vacancy rate? So the neighborhood vacancy rate, that's a great question that you can figure out from your property manager. So they'll basically know that, hey, in Oklahoma City, the average vacancy rate is 10%. So if I have 26 units, that means 24 out of 26 will be occupied. I have two vacant every time, right? So 90% occupancy to 95 is kind of in the more primary markets. And if you're like in a smaller market, like I own a 20 unit in Oklahoma. It's a smaller market, 50,000 population, and I expected the vacancy rate to be about 15%, so 85% occupancy. So that means 17 out of 20 are occupied, and that means I have three vacants at every time. And right now I have about two vacants right now, but I wouldn't be surprised if I rent them all out. So when you do a cash out refinance or they do a pro forma, usually the appraiser will do a market analysis and figure out what the vacancy rate is, and that's what they'll assume your net operating income based off of, right? So if it's $500 per unit times 20 units, that's $10,000 a month, right? And if you assume a vacancy of 85%, then that means that they're going to take $10,000 times it by 0.85, so you have $8,500. And at that point, you cut that number in half, 50% expense ratio, and that's your net operating income for the month, right? And at that point, your monthly debt service, so if you hit a DSCR of greater than 1.25. So it's just all math, right? So when I was doing cash out refinance in my 20 unit, I found out that my market vacancy rate was 15%. So the fact that I'm at 18 out of 20, I'm already above that. But honestly, I think I'll probably be 95 to 100%, um, you know, or occupied, to be honest. So, just know what those vacancy rates are. It's great for doing, underwriting, and it kind of helps that, like, all right, well, if the market, vacancy rate's 15%, then I might have to lower my rent a little bit to increase my occupancy, right? So if the market rent is like 500, and I know it's a 15% vacancy, I can help decrease that vacancy by maybe lower my rents a little bit. So maybe I'm at like 450, 475. Give them a little break to incentivize people to want to stay there. So question number 5 is what direction are economic and social indicators trending? So this is a great question, right? So economic indicators means, is there population growth? Is there job growth? And that's easy to figure out, right? So if you join my mentorship, there's a website called city-data.org. And what's nice about that website is you can search the address. So you can, type in, Enid, Oklahoma, and it gives you all the metrics. Like over the past 10 years, was there population growth? And typically you want to see a yes, right? Like in Enid, Oklahoma, there is population growth. Oklahoma City, there is population growth. Oklahoma is a steady Eddie growth market. It doesn't really grow up or down, but just steadily goes up, right? So you want to see positive population growth. You want to see a diversity of jobs, right? Like in Oklahoma, some areas like Lawton, Oklahoma, it's near, I forgot, military base or Air Force base. So that's great when they're there. But if suddenly they were to leave that city, then all the tenants and all the renters will leave as well. And then rents will drop down, vacancy will increase, right? So you don't want to be dependent. You want to see diverse jobs, right? So like in Oklahoma, it's very diverse. There's people working in the military, there's people working in oil, there's people working in healthcare, there's people working in education, there's working for the government. Jobs are moving there. They're expanding. There's growth there. There's, I think, projects to build like an amusement park in somewhere in Oklahoma. I'm not sure where, but it's definitely going to attract people there. And also something you want to look at is the social indicator. So, well, how's crime, right? Like you don't want to buy an area that's too much crime. That's a mistake I made in my mobile home park. The area was, had too much crime relative to the area. So if you look on city-data.org, you can see something called a crime coefficient. And you can see the trend over the past 10 years. So ideally, you want to be below a 500 crime coefficient, and you want to see a downward trend over the past 10 years, right? So if maybe crime was at 1,000, but now over the past 10 years is at 400, that's a good market. It's gentrifying, it's getting safer, it's getting better, there's a better demographic there, right? Versus, if an area that I bought in has a 1,200 crime coefficient and it's been consistent at 1,200 for the past 10 years. So crime hasn't improved, right? So that maybe means that, there's a lot of, legal activity there. Maybe the police force is underfunded. Maybe they're not active. So, for me, if the crime coefficient is too high, then you want to stay away. And you can ask the property manager too, like, hey, are there new jobs there? Like when I bought in Huntsville, Alabama, they're like, yeah, we're adding new data centers. We're having the arsenal here, all these job growth here. Tenants are moving, people are moving here. So if you have more jobs coming there, what does jobs mean? It means people want to move there for work. If people move there for work, there'll be more demand for housing. There's more demand for housing, then rents will go up, right? So these are all things that you want and things that I'm seeing too, right? So that's question number 5. Question number 6 is who's going to manage the property? So, this ties into the prior answers. You want to have property management. So I buy real estate where I have good property management. If you have a great property manager in Arizona, invest in Arizona. If you have a great property manager in Las Vegas, invest in Las Vegas. If you have a great property manager in Arkansas, invest there. Wherever you have a great property manager, follow them, right? Like for me, I like to invest in the Sunbelt area. So if you draw a smiley face on the U.S. map, whatever's underneath that, I invest in. I don't want to deal with snow, right? That's not my cup of tea. I'm from California, right? I don't want to deal with snow. That's why I kind of teach my students like just whatever is under the sun belt, because I'd rather deal with desert versus burst pipes due to ice, right? Like I don't want to deal with like shoveling snow and like the heater is breaking, because if the heater breaks and it's cold, it's uncomfortable. Versus if it's really hot and the AC breaks, I mean yeah, it's inconvenient, but it's not the end of the world. So for me, I don't like dealing with um, snow. So that's how I invest. So if you have a great property manager, wherever that is, follow them, right? Because people tell me, Steven, hey, like one of my students went up to me and said, I used to live in San Antonio. I lived there for 4 years. I got family there, and yeah, I know the area. So I'm like, great. Just find a property manager there now, and that's your unfair advantage, right? So it's really easy. It doesn't have to be that complicated at all. Next question is how does my cash on cash return compare to other potential investments? So, obviously I'm very bullish on real estate. I like real estate. I built 80% of my wealth in real estate. Like if you were to draw a pie graph of my net worth, 20% is from like stocks, cash, life, whole life insurance, index funds, 401k, all that stuff. And then 80% of my wealth is from real estate. So for me, I built a lot of my wealth in real estate. And, for me, I think cash on cash is like one of the metrics. So cash on cash return is if, I'm putting in $1,000, I have 10% cash on cash return, I expect to make $100 in a year. Right. But one thing that people need to factor in is that there's a lot of things going on in real estate that isn't necessarily part of the cash on cash return. Right. So when you buy real estate, you have tax benefits, right? So if you buy apartment complex, you can do a cost segregation study and then write off 30% of the cost of that apartment complex and write off your active income if you're a real estate professional, your passive income if you're not. So if you buy $1 million apartment complex and you do a cost segregation study, you can accelerate about $300,000 day one, and that can wipe off your active income if you're a real estate professional, or 300,000 of your passive income if you're not. Right. So like if you're at a 30% tax bracket like me, and you can write off 300,000, that's saving you $100,000 up front. Right. So if let's just say for context, I basically bought a $1 million apartment complex. I put 25% down, so I'm putting in 250K, and right off the bat, by putting in 250K, I get $100,000 in tax savings by doing a cost segregation study. So if you kind of do that math right there, that's almost like a 50% return on your money that you invest in that apartment complex, and that's just only one benefit, right? So not only are you getting tax benefits, that's depreciation, right? You're getting appreciation. So if you buy the property with instant equity day one, like what I teach my students, then like my apartment complex, right? I literally put in about $70,000, and it appraised at 250K over what I bought it for. So I put in 70K, and I made 250K of net worth. So that's like what, like a 400% return on my money, and it's not including the tax benefits. But that's appreciation, right? And then you can buy appreciation day one, and you can force appreciation by increasing the value, right? That's what I'm doing. I'm going in, I'm renovating the units. When I renovate the units, I get higher rents. When I get higher rents, I get a higher net operating income. When I have a higher net operating income, I increase the value once again, right? And then the next one is principal pay down. So every month you're collecting money, right? And then you're paying down your loan. And, in the beginning, when you have a loan, some money pays interest, some money pays on the principal, right? So it's kind of paying back yourself, right? I mean, like, for example, my monthly mortgage payment, my 26 units is about $2,000, but maybe like $400 goes to like principal, 1,600 goes to interest, right? So, there's like four ways to make money in real estate. So just don't look at cash and cash return. um, Obviously that's a cherry on top, but there's a lot of other benefits to real estate, and you have to do it like long term as well. So, so that's kind of the advantage of real estate. That's why I like real estate, versus if you do index funds, it's like typically 7 to 8% cash and cash return over the long run. And, it's easier, right? You don't have to manage it. It's more passive. You can automate it versus real estate. You get more benefits of it, like those four benefits I listed, depreciation, appreciation, principal pay down, and cash flow, right? But it comes with a lot of work, comes with a lot more stress, and right? It's just more work, more stress, more money potential, right? So, that's what you have to really analyze. So that's why I said if you want to invest in real estate, you have to commit to continuously learning about real estate and doing better, right? That's why I'm huge on investing in education. That's why I invest in mentorship. That's why I create a mentorship. That's why I invest in coaching. That's why I create coaching, right? So I want people to learn from my mistakes and not make the same mistakes. So number 8 is how is the neighborhood in the path of progress. So this is gentrification, right? So maybe an area wasn't that great, but it's in the path of progress. There's a lot of new developments there. So kind of the joke is if all like kind of the hipster artsy people start moving there, and how it's more hipster and artsy is when you start to see like murals painted everywhere. You see more cafes, and when you go to the cafes, you'll see a lot of people who are writers, who are artists, whatever, right? They're kind of more artsy, like skateboarders. They're more artsy, and it's like gentrifying. So at that point, you can kind of figure it out, right? Or if you kind of see like, okay, this area's a little bit rough, but they're adding a Whole Foods there, they're adding a Chick-fil-A there, they're adding a Super Walmart there, and that means that that it's in the path of progress because Walmart did the research already, Whole Foods did the research already. Chick-fil-A did the research already, so they know it's a growing area. It's in the path of progress. It's gentrifying, so you can leverage their research and then start investing there as well, right? So like in Oklahoma City, a big one is called Capitol Hill, and historically, it's a predominantly Hispanic area, and it had a lot of crime, right? It had a bad reputation, but what I'm hearing now is it's in the path of progress, where a lot of the more artsy people in Bricktown are going there. There's gentrifying, so if you can find a good deal, and you get to rely on your property manager to know that, okay, this is a good pocket, this isn't a good pocket, and then you can kind of go in there and then invest in real estate, right? So you can get a great deal, but like I said, you have to really rely on your boots on the ground. Like in California, um, Southern California, like the Silver Lake area in Los Angeles is gentrifying, right? Like it used to be a bit rough, but now like all the hipster artsy people go there now, and it's like in the path of progress. So once again, you want to rely on the property manager for that question. And then number 9 is, how do the cash flow numbers compare as a short-term rental? So um, this isn't as applicable to probably multifamily, or it could be. So, like, for example, when you have a 20 unit apartment complex, and assuming your apartment complex is near an area that people want to be at and want to explore, you could explore the model where, like, you can have, like, the majority of your units. I would recommend at least 80%. For if you want to do cash out refinance, but at least 80% of your property should be like a long term rental, right? So, for example, at my 20 units, 16 out of 20 will be a long term rental, and I can designate 4 units maybe altogether at the end and make those into like a short term rental to have that higher income potential, right? Because sometimes short term rental income can be double to triple the rent. So if I'm only getting $500 a month in rent, as a long term rental, I could potentially get 1,000 to 1,500 as a short term rental. I mean, obviously a lot more work goes into it. There's cleaning fees and whatnot, and it's more of a business. And so that's a way to juice up your cash flow. But why I caution that you want at least 80% to be long term rentals is because some lenders, they don't honor the short-term rental income, right? Because they view it as risky. Like they like to see long-term leases, like a lease that's for a year, 2 years, 18 months. But they see that it's like Airbnb or like weekly rentals. Like I remember I was trying to buy one apartment complex that was a weekly rental, and he was charging more. So like for example, as a long-term rental, he get $700, but as a weekly rental, he get $900. So you gain $200 more per unit. But then when I brought that to my lender, Bank of the West, they're like, no, we don't like that. We want to see long-term leases. It's too risky for us. It's almost like a hotel, and it's too risky. So they didn't like it, right? Even though it was getting more income, and so that's why I'd say, obviously you can do short-term rentals if you're just buy and hold and you don't want to do cash out refinance. But as you're starting to prepare to do cash out refinance, just know that that might be a barrier you run into if you want to designate some of your units as a short-term rental. And this number is really, I mean, knowing how the cash numbers compare as a short-term rental is great if you have a single family home. So you want to know, okay, if I have a short-term rental in this area, like what can I potentially get? And worst case, if I can't get any business, or maybe the regulations change and they don't allow short-term rentals, like how can this function as a long-term rental and it will still work as a long-term rental? So you always want to make sure it works as both, right? Like, does it work as a long-term rental? Does it work as a short-term rental? So that you have options in how you pivot. So overall, these are 9 questions that I typically like to ask myself before buying an apartment complex. Hopefully, you found value from this and learned something from this. So if you have any questions, please place a comment down below. I'd be happy to add to one more of these videos. Hope to see you in the next one, and thank you so much.